Welcome to Burgernomics, demystifying economics with Ross MacDowell.
Hi everyone, I'm Ross MacDowell and welcome to the Burgernomics podcast, where Australia's leading experts and I demystify economic topics that affect you. Welcome back to part 2 of our chat with the Grattan Institute's Economic Policy Program Director, Brendan Coates, discussing Australia's house price boom. In part 1, Brendan and I discussed how Australia's housing market is divided amongst renters and homeowners. In part 2, we get into booms and crashes, their causes, how it affects you, and can they be predicted? Brendan applies the famed Burgernomics test to our housing market. I guarantee you'll be thinking about housing when you eat your next hamburger. Brendan and I kick off part 2 discussing the history of Australia's housing price booms. Let's get into a little bit of the history of Australian housing booms. There's a lot of people out there that currently want to buy a house and they're nervous. They don't know what's going to happen to the housing market. They think, oh, what if I step in now and I totally commit myself and then it falls over? Or what if I don't step in now? I'll never own one. So to put things into context for them, on average, well, first of all, what would you call a boom? What would you call a correction? What would you call a crash? What sort of percentages would you attribute to these fantastic media terms?
That's a really good question, Ross. So, Australia hasn't had the last housing crash in Australia, in a sense, was actually probably sort of in the late 80s was the sort of last really big one. Now, it's worth pointing out that you often see price swings of 5 to 10% as interest rates or credit moves, as it's steadily moved up. In fact, if you look at a graph of house prices, say, since 1995 in Australia, they've gone down a couple of times. They went down, after the run up in 2004, they went down a bit. They go up again and then come down in the GFC. They come down a bit recently. And then, but over that time, house prices have kind of doubled or tripled. So, to me, that we often just use the dramatic terms like crash to reflect sort of gyrations in prices they're big experiences for the buyers and sellers, but they're just the noise in the upward trend that we've seen over the last 30, 40 years. So, the last genuine crash in Australia was, I think, in the sort of late 80s, early 90s. The biggest one Australians ever had was in the late 19th century, when there was a real land boom. So if you're in Melbourne, you look around at all the train stations, that's sort of the network that runs out of Melbourne, that was all built off sort of a boom in land prices through the 1870s and the 1880s. And it all came crashing down, and prices took 40, 50 years to return to their pre-boom levels. That's a crash. The late 1980s, early 1990s, that was a crash, smaller. What we've seen recently, I would just see as gyrations as prices move around over time. They're assets. This is what happens in asset markets.
So, like the share market, which is an asset market, you would say a correction is 10%. You'd say a crash is 20% or above. I don't think anyone has come up with a definition of a share market boom, because they never want to think that they'll end. So they're never ending in the press, a boom. What would you call, at the moment, you'd say the Australian housing market is booming because we've got around 20%, depending upon what state you live in, 20% increase over the last 12 months. That's a booming market for you?
Well, it's hard to describe it as anything else. As someone trying to buy a larger house in this market, it feels like a boom. And I think it would be insensitive to say anything else. It's a 20% increase in prices. That's huge in such a short period. It's just an effect that you can probably explain with the underlying economics pretty well.
Okay. So on average, and I know averages are difficult things to describe, on average, how long do the booms last?
Look, you're talking about often 20-year odd cycles, but I think I don't like to look at it and sort of go, oh, there's like a natural cycle every 20 years, there's a crash. I think you've got to look at what's driven prices, like what's the mechanism.
Right.
And the mechanism is that interest rates were at 17% in 1989, and now the cash rate's at 0.1%. You can borrow a mortgage for less than 2%. And that's the boom has been driven by that drive down in interest rates.
Every time? Or would you say that each of the booms is really caused by interest rates, but it's just dressed up a bit differently?
In the booms are typically caused by, the kind of booms we're talking about, like big increases in prices in a short period. They're caused by financial factors because, you don't add 70% to the population, except for the 1850s. We don't add 70% of the population in 2 years. So what's changing is three things. One, interest rates potentially. Two, access to credit. And three, people's expectations that can feed prices once they've taken off. They can take off. Like you can have irrational housing markets, or exuberance irrational exuberance, as Alan Greenspan used to talk about.
Yep.
But it's normally the financial factors that are driving these gyrations over the sort of short to medium term.
Okay. So if we go from a boom to a bust, which has happened, we have a concept that comes into play called negative equity with housing. And negative equity is when, well, please, you explain negative equity for us.
No worries, Ross. So, people normally, particularly first-home buyers, because that's who most likely ends up in negative equity, first-home buyers and investors. You buy a house normally, in Australia, you have to pay extra on insurance if you're borrowing more than 80% of the purchase price. So the average first-home buyer buys a house with a loan that's 83% of the purchase price on average. And that's been pretty constant the last decade. That means you've got equity in the house, of 17%. Now, negative equity is where over time, because of a fall in prices, the house is worth less than the loan you have outstanding on the property. This is a big problem in the US during the global financial crisis, where a lot of people were stuck in a world where they couldn't move because the house is worth less than they owed the bank. So the only thing they could really do is stay still, hold on until house prices recovered. Okay,
so all of a sudden, I buy a house for $1 million. The bank owns $800,000 of my house. The market determines that my house is worth $750,000. So therefore, all of my equity's been wiped out of it, and $50,000 of the bank's equity's also been wiped out of it. What does the bank want to do when it's holding an asset that it is devalued and it's in your hands?
Well, they get worried because residential mortgages account for 60% of the lending books of the major banks. So it is the biggest sort of exposure that they have. This is why, the RBA and APRA run these stress tests of the banks, what they're basically doing. So the worry is if you see a big house price fall, the concerns are twofold, like from an economic perspective. One is as prices fall, then people's willingness to consume falls. So they cut back on spending because they don't feel as wealthy. But two, the big worry is always, as we saw in the US in 2008, if the bank lends that person $800,000 and the house is worth less, then they're not going to get their money back. And that worries the banks because if that happens at scale, then if the bank has to foreclose, if it has to sort of foreclose and it loses money, then the bank has to take a hit to its equity. So every banks lend money, and the lending has to be backed by capital, which is the shareholders' money. Now, the standard, bank has capital worth, 10, 12% of its risk-adjusted assets. That means that if the bank loses money on a share of those loans, then it eats away at the capital of the bank. And the risk, as we saw in the 1930s, we saw in the late 19th century in Australia, as we saw in the GFC in the US, is that the bank can become insolvent. It can go bust because its capital is eroded. That's why the banks and APRA stress test, the RBA and the APRA stress test the banks to make sure that they can withstand big hits to their to their loan books. And that's always the thing that worries regulators as soon as prices start falling. I think it's a really underappreciated reason. It's an unappreciated problem with a world with really high house prices and high debt, is that regulators get worried if prices fall quickly. And Treasury and the government gets worried if prices fall quickly. I don't think it's a conspiracy where they always want prices to rise, but it is an inherent bias that you get really worried when you've got these high levels of household debt about seeing prices fall, because you start to worry about the financial system pretty quickly.
So if I'm the CBA bank, I've currently, as of last week, got $1.01 trillion in assets, made up of $458 billion of mortgages, and the property market turns down rapidly and largely. I've got lots of negative equity amongst my mortgage holders. Isn't it in my interest to go, let's just not forgive them their money, but let's just lengthen the terms of the mortgages that I've given them, so that it takes the pressure off us as a bank to have to take hard decisions? Because if we were to take hard decisions and foreclose, that's just going to add more supply stock back into the market and create an even bigger crash.
That's right. And so one difference between Australia and the US is, in a lot of US states, they had rules around bankruptcy where there were no fault mortgages. Basically, you could just put your keys in the mailbox, and if you were in a situation of negative equity, it became the bank's problem. You're just like, thanks very much, I'm walking away from the loan. It doesn't work like that in Australia. If your house is now worth $750 from $1 million, and you've got an $800,000 loan, and you try to walk away, the bank will come after you for the remaining $50,000. If they sell it. Banks don't like foreclosing mortgages because often a foreclosed sale gets less than the market value. You're also selling into that sort of falling market. And that's what, I think we saw that in the late 1980s, where banks tried to be very careful about not selling properties unless they really had to. You're certainly not going to allow someone, but the problem for the banks is that if a loan becomes a non-performing loan, then the amount of capital they have to hold against that loan increases. APRA's rules are if a loan is solid and person's making their repayments, they only have to hold, I think it's, I talked before about risk adjusted capital buffers. A loan that where the bank, where the repayments being made, the risk rate is 20%, which means they only have to hold 1/5 of the capital against that loan. If it's a loan that's got a non-performing loan, they often have to hold 100% of the capital weighting. So they have to increase their capital. They have to get more equity in, which is what you'd expect banks would have to do in the event of a problem, is that the existing shareholders would lose a lot of money because their equity is there to get the dividends during the good times. But if banks run into trouble, equity holders lose out first. They'd probably have to recapitalize the bank. We saw this in the US and the UK, where government in the UK actually just took over banks by basically providing capital to make sure they didn't fall over. The risk in Australia, because the premise, Ross, is kind of like, how does this happen in the Australian context? I think I look at the Australian housing market right now, and there's a little bit of risk that the quality of the lending is falling because people are taking out larger mortgages. But on the whole, people are taking out these mortgages because the prices are kind of justified by low interest rates. The question is, what happens if interest rates rose? Now, it's almost like a ratchet. When you've got very low rates and it's led to lots of debt, it means you probably don't need to increase rates as much to get the same effect on inflation, because that's why you raise rates. There's no natural level of rates that you're going to try to. We're not going to get back to a world of 7%
17% rates,
or 17.
But the Reserve Bank do want rates to be higher than what they are now, because they want themselves a buffer in case there's another economic problem either in the world or in Australia. They want to have some flexibility.
They do, but what their mandate is, their target is full employment and low inflation. And so they're not going to raise rates in a world where unemployment isn't back to sort of the levels of what they think of as like a full employment level, which is somewhere between probably 4.5%.
Yep.
And where inflation's rising. So Lowe has been very clear, the Reserve Bank Governor Phil Lowe, in saying they're not going to raise rates until inflation is sustainably within the target band of 2 to 3%. It hasn't been in that band for 7-8 years now. So I think they'd like to be able to raise rates, but they're not going to raise them prematurely to normalize just for the sake of normalizing. Monetary policy is a complex area, but the way to think about it is, the way that the Reserve Bank thinks about it is, there's some neutral risk-free interest rate, which is determined by the global demand and supply for savings. We've had a heap of savings because populations have aged, rise of China, growing inequality is a potential driver, which means that risk-free neutral rate has fallen. And that's why interest rates are low. So they're not going to raise rates now to sort of get us back there. I suspect the more likely outcome is you raise a little bit, but I don't think we'll be going very far up before, because if you raise rates by a percentage point, and my mortgage rate goes from 2.5% to 3.5%, you've just reduced my purchasing power by, you've increased my mortgage repayments by 15-20%.
But haven't the banks really got around that problem? Because, for example, when I went for my first mortgage many, many, many years ago, it was pretty simple. You had to have 30% of the purchase price of the house. They would give you 30 as a monthly repayment, 30% of your gross, not your net, of your gross wages. And that was calculated over the rest of your working life. And your working life was defined at 65 years of age. And that's how it went. That's how we built the post-war baby boom housing situation. Now, I notice that what the banks do is they'll give, for example, someone that's 45 years of age a loan with a term still of 25 or 30 years, out until, in some cases, they're 80 years of age. Well, then they're going to stop working at 67, apparently, according to the federal government. And so banks are lending money against future equity in people's homes. So therefore, people will have to sell their homes at age 67 when they stop working and can no longer afford the mortgage repayment to return the equity of that house back to the bank. So aren't the banks really insuring themselves against any problems in the future by having these incredibly long repayment periods?
So first of all, it makes sense to have longer repayment periods when houses are a larger multiple of incomes, because it means you're spreading out the pain over a larger share of your life. So that makes a lot of sense to me, to have 30-year mortgages. We used to be more like 25-year mortgages. They're going to get longer, I think. What I think the banks are doing is they're probably expecting that if people need to sell, if people need to sort of pay out some of the mortgage at retirement, they'll use their super. Now, that, in a lot of sense, actually makes sense. There's a whole other conversation we'd have about the adequacy of retirement incomes. We don't think there are big problems there. But so we think the current, rates of super contributions are fine. You don't need to increase them from 9.5 to 12, which is what we're doing now. But that's kind of what I think the banks are expecting. People have got this big other asset, which is their super. And all the research shows the thing you want to do when you hit retirement is to pay off your mortgage. And then if you own your own home outright, you'll probably be okay in retirement. And so I suspect what people are doing is they're expecting they'll use some of their superannuation
to do that,
to pay off the loan.
Okay. Before we get on to the hamburger effect, I just want to talk to you about the canary in the coal mine, because you have mentioned throughout our podcast so far, really it's all about interest rates. We've got to keep interest rates low. That's the reason why the housing market continues to grow. If we were to stop the interest rate party, then there's a lot of problems from everybody. There's this particular measure called the 10-year Australian government bond yield. So without getting into a great long explanation about it, it basically forecasts the risk-free rate in 10 years of where interest rates are going. It's used as a predictor of where interest rates are going in the future. You mentioned 1 or 2%. I recently sat with a very senior executive of one of the big four banks at lunch, and he said to me, if we were to increase interest rates by 2%, the cash rate, well, a mortgage, if the cash rate was to go up by 2%, we'd pass that through to mortgages and basically the whole system would collapse. You'd have all four banks going to the Reserve Bank going, please give us a whole lot of money, we can't survive. Now, in the last week, we've seen the Reserve Bank of New Zealand increase rates by 0.25%. The world is talking about inflation and going in this direction. The 10-year Australian government bond yield, is that the canary in the coal mine? Is that the thing that is going to bring the party to an end?
So, the 10-year bond yield right now, when I look at the numbers, is 2.2%.
Mm-hmm.
So that means if the Australian government wants to borrow for 10 years, it's got to pay an average interest rate over that period of 2%.
Mm-hmm.
So, that to me suggests that in 10 years' time, market expectations are that interest rates will be at 2.2%.
Yeah, currently, but they're saying some of the economists, the financial people in the banks, based on what the overseas inflation trend is and what's happening with the US Fed, that the increase in interest rates is going to happen at a quicker rate. And they're predicting that could result in a 5% 10-year bond yield.
Yeah, okay. So there's a series of forecasts out there for higher rates. So here's the thought experiment I do. So, because you remember that you've got to think about who's making this decision. The group making this decision is the Reserve Bank, right, of Australia. And so if you think about, okay, what happens if interest rates rise by 2 percentage points in the next year in Australia? What does that do to the Australian economy? I think it crashes you into recession, right? If you're talking to people who are in the banking sector, they think it would wipe out a whole bunch of potential home purchases, home mortgages. That to me suggests the answer is it won't happen, because the Reserve Bank's job is threefold. One, stable prices. Two, full employment. And three, supporting the well-being of the Australian population. They're not going to raise rates by that amount of money. The only world in which they'd raise rates by that amount of money is if inflation has gone up, So that's what's happening in the US. Inflation's high. The question is how long it stays at that level for. That's potentially like a whole nother discussion, but it does mean the Reserve Bank its objective is to get inflation back into that 2 to 3% range. Higher interest rates aren't going to get it there. If inflation rose into above that 3% level, they would raise interest rates. You got to remember that if inflation's higher, then your take-home pay also increases.
There's a lag effect, isn't there, between inflation going up and people screaming and saying, increase my wages.
Yeah, it's a lag of normally within a year, right? So if you get higher inflation, then your bargaining will have that effect.
Yep.
One thing we haven't talked about is the fact that house prices, a loan is set at, in the prices that prevailed at the time. So, I borrow $1 million. We'll use your example, I borrow $800,000. Then, there's this concept called mortgage tilt, which is that my wage goes up. My wage partly goes up because of inflation.
Yes.
But your loan doesn't. And so normally people might start off, if your example, with 30% of their gross income on a mortgage. 10 years in, it's 20% of their gross income on a mortgage, even if assuming interest rates don't change. 20 years in, it's 12, 13% of their income on a mortgage. That's what's tended to make housing affordable, is the first 5 years of the period where things are tough. And so even a world where interest rates were to rise, that would be a world where inflation has increased. Now, if it's a sudden sharp increase in inflation and doesn't get priced through to wages, that's a problem. Their real purchasing power falls. But I think in most worlds, that's actually one of the reasons why housing became in hindsight, quite cheap for older generations is that they thought they were going to be paying 17% interest rates. The inflation rate was high. It was 5, 6, 7%. And so 4 years down the track, the loan's worth relative to inflation 30% less than it was when they took it out. And so I think that's the world I think you've got to keep in mind. Now, the objective here is not keep rates low to keep rates low. I'm ambivalent of where rates go. I'm a mortgage holder. I'd love them to stay low. But the objective for the bank is to make sure that they hit their full employment and inflation target benchmarks, and they will do whatever is required for that to happen.
To do that. Okay, Brendan, now we get to the really important part of the podcast. This is where you, as Australia's smartest housing expert, gets to apply our current housing market to the effects on a hamburger. I want you to think about all the range of people we've discussed and the effects of our booming housing market, or if you want to take it, you can even discuss a housing crash. What are the scenarios on hamburger sales, hamburger production, in a true Burgernomics term of Australia's current housing situation? Good luck.
Thanks, Ross. And yeah, flattery will obviously get you everywhere. I'd say we're probably one of the more independent housing research outfits in Australia because we don't have a stake in either side. So we sort of talked a little bit about this before, which is conceptually the way you should think about, renting is like buying a burger from McDonald's, and being a homeowner is like owning a McDonald's that only sells burgers to you. Only, you buy your own McDonald's so that you can have a burger whenever you want it. That's the rent that you get, the benefit you get from living in your own house. You're not paying rent to someone else for the privilege of living in your house. Okay, so how do we explain what's happened in the Australian housing market over the last few years? Well, as interest rates have fallen, then the value of shares in McDonald's have increased. It hasn't had much of an effect on rents. So it hasn't had much of an effect on the price of burgers that you're actually getting out the door, that you're selling out of your Maccas, but it has had the effect of upping the value of those shares, because we know that there's a clear link. As you reduce interest rates and discount rates, then that has the effect of increasing the value of the share. So that's kind of what's happened in the last few years. What that's meant is, okay, it's become easy to borrow to buy Maccas. That means we've built a few more McDonald's. That does have a bit of an effect on rents or McDonald's burgers, because there's more supply of Maccas. That's one of the ways that interest rates affect the real economy.
Okay.
It's probably meant a few more people are employed and can go and buy burgers at McDonald's. And that's why, to take your example before of like rising interest rates, what would that do? Well, the price of Macca's shares would fall. Fewer people would be employed. Fewer people would be able to go and shop at your Macca's. That would probably have some small downward effect on the price of burgers. But the main reason Macca's prices would fall for buying a shop is because the shares had fallen because the interest rates are low. Now, think of a world where you can't build enough McDonald's because there's planning rules that say that you can't go and build one on a new shop corner. Well, what does that do? Well, it means that the price, there's unmet demand for Macca's burgers. It means the prices of Macca's burgers you're selling through your store rise. So that's the rent that you're paying for your house. That's why rents rise. In a world where there's more demand from migration, we all want bigger houses, and we don't allow enough new burgers to be made because we're not allowing the McDonald's stores that make the burgers to be built. Then if you think of the tax concessions, well, I get a tax break from owning a McDonald's. If I own a McDonald's and I'm borrowing to pay to own that Macca's, and I make a loss on my Macca's, well, I can offset that loss against my other income.
On your tax, yeah.
Tax, so I pay less tax on my labour income. Okay, that's negative gearing. You have a discounted tax rate on the capital gains I make on my Macca's. So if my Macca's goes from being worth $1 million to $2 million, I only pay tax on half the gain. Great. Well, that's capital gains tax affecting housing. And then, if you have more, from there, let's think about what happens if you have a crash. Well, lots of people get excited about Macca's. They can see the prices of McDonald's are going up to buy. The price of the burgers isn't going up very much. What happens? Well, maybe the banks become a bit more comfortable lending lots and lots of money for people to buy McDonald's. In fact, it's 60% of their lending book, like the Australian housing market. What happens then if some of those people are unable to, there's not enough demand, or people have borrowed money and then they can't repay it? Interest rates rise. Well, then they have a fire sale of McDonald's. So there's McDonald's on all these street corners that are for sale. That reduces the price of McDonald's. Does it change the value of the price of the burgers? Probably not so much. Again, doesn't affect rents very much. What does that mean for the banks? Well, then you've got a world where they own all these Macca's stores. They foreclosed on the owners, but they're worth less than the debt. Well, then we've got the scenario we talked about before. So I think that the analogy of Burgernomics actually works incredibly well for housing, because I think it actually explains kind of how to think about the two markets for housing, for owning a McDonald's store or walking into one and buying a burger, or if you're in Melbourne at the moment, getting on Uber Eats and asking one to be delivered to your door.
Brendan, that is a fantastic explanation. You are getting the prize for the best correlation between your topic and explaining it through Burgernomics. So thank you very much. Thank you for joining us. What you said is really fascinating. Let me ask you one thing in closing. With this incredible cumulative knowledge you have of the housing market, on the one hand, but on the other hand, you're currently looking to buy a house. Does that help you or hinder you?
That's a really good question, Ross. I think where my thinking has evolved over the last few years is thinking more about the financial aspects of the transaction. So, and I think that if you do that, you need to have almost two conversations inside your brain. You need to have the conversation about what drives prices in the short term, which is interest rates and credit, and then what drives underlying demand and supply, which affects rents over the long term. So I think a lot of people get stuck sort of thinking, oh, well, migration's going to come back, so house prices are going to boom, or migration fell a cliff and house prices are going to fall. The way I described COVID was to say, look, we've got an experiment running. I did this on a podcast early on in COVID. Because we don't make forecasts, but I was skeptical of the big declines in prices being forecast. It's like we've got an experiment. We're about to find out what matters for prices in the short term, like underlying supply and demand fundamentals or interest rates and access to credit. And it's pretty clear in the short term, we know the answer. How did we have 20% house price boom in the middle of a world where migration came to a standstill? Well, it's because interest rates affect prices much more than what the falling in rents affects from migration affected rents and therefore prices. So look, I find it helpful now because I think I know I've got a good handle on the whole story. That said, I'm looking in 5 submarkets of Melbourne. I'm looking in 5 suburbs around Melbourne. The person who knows more about what's driving demand and supply in that particular market, that particular time, is probably a real estate agent. So it is helpful, but there's a lot I'd learned from talking with them and talking with people who are experts in investing in houses that you don't get when you're looking at it from 30,000 feet.
Wow. So I feel for you, because as you walk through the door of this house that you love and your wife is there pulling on your sleeve going, this is the one, and then you're torn between a fantastic knowledge and the emotional pulling of wanting to purchase that house. That must be incredibly hard, I think, sometimes.
Economists don't always make great investors.
Thanks for joining us on today's podcast. I never realised there was so many factors affecting the demand and supply of Australia's housing market. I encourage you to listen more than once to Brendan applying Burgernomics to the Australian housing market. There's just so much in it. He weaves together explanations that cover hamburgers from a business economics perspective and a fascinating analogy using burger purchases to describe house renters and the burger shop as the homeowner. My thanks to today's guest, Brendan Coates, Economic Program Policy Director of the Grattan Institute, and Ology Creative for providing all our design visuals. Please subscribe to the Burgernomics podcast on your favourite podcast platform. I am also interested, always, to hear your comments, so please leave them on the Burgernomics podcast feed on Twitter, LinkedIn, or Instagram. Thanks for joining us.